Hello, and welcome back to our final chapter dealing with financial accounting. This is chapter 13, and chapter 13 deals with analysis and interpreting the financial statements. So, in this chapter, we're going to look at the income statement. We're going to look at the multi step income statement, actually. We're going to look at some earnings persistence, and we're going to be able to, or you should be able to, let's put it that way, should be able to discern between what type of revenue streams are persistent, meaning they happen all the time, versus which revenue stream or earnings rather are transitory, right? Meaning they don't happen all the time. Okay, so let's go ahead and jump in and let's look at persistent earnings, and we're going to talk about how to format the income statement. Okay, so it's important that we recognize, and again, this goes way back to the beginning of the course, what is the purpose of accounting information, right? And accounting information, accountants provide information to decision makers, right? So they can make decisions based on operations, investing, lending money, borrowing money, whatever. So it's really important to understand that as we prepare this information, it should have some predictive capabilities, right? Meaning somebody who is knowledgeable about accounting and finance should be able to look at our financial statements and predict future cash flows, okay? So in order to do that, it's important that we determine the earnings or we separate our earnings and we separate them out as far as which ones will continue into the future, or determine the earnings ability to predict future cash flow. Are these persistent earnings or these transitory earnings? Well, when we're looking at persistent earnings, these are earnings that are expected to continue into the future, right? Cash flow from operations. We expect that the company will generate cash flow from operations forever until the company goes out of business, right? Transitory earnings are single period events, okay? Maybe we have a gain or loss on sale of equipment. Maybe we have a gain or loss on an insurance claim. Those are the things that we're talking about. And if we put those things, lump those things in with our earnings power or our earnings potential, investors won't be able to discern, okay, well, are they going to have a gain on insurance loss or gain on insurance every period? Are they going to sell their assets every period and always have a gain? So it's very important that we differentiate between the two earning streams, really. Okay, so if you'll notice, what we have here is the multi-step income statement, right? And what we do is we prepare it in such a way, or we organize the information in such a way that it separates items according to persistence. The more persistent items obviously are going to be at the top of the financial statement. So notice we have sales revenue, cost of goods sold, operating expenses, right? Those are all, or net income or net operating income. Those are all usual and frequent items that will always appear as the company does business. Now, we have some other income and expenses, which these are kind of unusual, okay? Interest income. Well, we only get interest income if we lend money to maybe another business or whoever. Well, our core business is not lending money. Our core business is selling goods. So that's an unusual item. Same thing with interest expense, right? These are usually unusual, right? When are we going to borrow money? Well, when we need it, right? If we have enough cash internally, meaning cash flow from operations, to finance our growth, then we won't need to take out a loan, okay? Same thing with gain on sale of equipment, right? Those are unusual. yes, they're going to happen, but it's not part of our core business operations. Okay. Income tax, that's going to be usual and frequent. We're always going to have income tax, um, an income tax payment. The next thing we have is net income from continuing operations. That should be discontinued operations, because basically what we're looking at here is, what if we have to discontinue a division, or what if we have to dispose of a specific item within the company? That's infrequent. So notice we put those closer to the bottom of the multi-step income statement. Okay, and we say that these things, any like gain on operations from discontinued division, any loss on disposal of discontinued division, those are almost always going to be infrequent items. So what exactly are discontinued operations, right? Well, we need to report these separately, because basically we're saying, hey, we're getting out of this business. Think of like General Electric, right? They have like a ton of divisions. Okay, they have gas turbines or turbine engines. I'm drawing a blank, but they have a ton of other ones, right? So let's just say, for example, that they want to discontinue that operation, meaning they don't want to do turbine engines anymore. Maybe they want to get into, I don't know, making another type of engine or something like that. So what we're going to do is we're going to report any gain or loss from that discontinued operations separately, okay? So we're going to report the income or loss from the segment's operations for the portion of the year before we discontinue it. So let's say that we're going to discontinue this next year, this operation, right? Well, we're going to go all through 2020. At the end of 2020, we're going to discontinue this operations. When we do our 2020 financial statements, any income or loss that's generated from that segment is reported separately. And then any gain or loss from the disposal of the segment, maybe we sell off the assets, maybe we actually sell the entire division to another company, we're going to report that as well under discontinued operations. Okay? Now, when we're talking about changing in accounting principles, right? Remember we looked at LIFO and FIFO, right? And I believe we did talk about this when we calculated inventory costs, but just as kind of a refresher, companies are allowed to change accounting principles from one approved generally accepted method to another generally accepted method, right? They can do that. The only catch is they have to show the reflections in the financial statement results, right? So basically what that means is we require those financial statements to be restated. So we'll take prior financial statements, we'll apply that new principle to those restated financial statements. So that way any investor can get an idea of what the change was, right? So let's just say if we go from LIFO to FIFO and I have, better income, right? Well, the reason why from year one to year two that change is maybe so dramatic is because I changed accounting principles. So to get a better comparison, I need to go back, restate those prior year financial statements using that LIFO that we changed to, okay? So when we're looking at comprehensive income, this is actually pretty important because basically what GAAP says is there's certain things that we need to report, okay? So when we're looking at comprehensive income, this includes the items that generates wealth for the company. But GAAP says, you shouldn't put these on your income statement, okay? So what are we talking about? Well, if we have net income from the income statement, changes in market values of certain marketable securities, any unrealized gain or losses, right, that we have from foreign currency exchanges, okay? So basically what we need to do is we have this comprehensive income section. And basically what we do is we report these by attaching them to the income statement. They're actually at the bottom of the income statement. Kind of looks like a separate statement, or it could be part of the statement of shareholders' equity. Okay? So the real nuts and the bolts of this chapter, and I think the real interesting and fun part of the chapter, is doing this analysis, right? Looking at sources of financial information that investment professionals use to make basically investment decisions. So the first thing we're going to look at is horizontal financial statement analysis. Horizontal financial statement analysis, super duper easy, right? So actually, when we're talking about financial professionals and what they look at within the financial statements, they're looking at not just what the numbers are, but how the numbers compare to other numbers. How do they compare to the trend, right? Has this item consistently increased or decreased over a number of years? So we're going to be looking at three types of analytical tools, if you will. We're going to look at horizontal analysis, which we call that trend analysis. We're going to look at vertical analysis, which is we call that common size analysis. And then finally, we're going to look at our ratio analysis. Now, as we've been going through the semester here, we have been looking at some of these, so we're going to bring them all together, okay? So what we have here as an example is a comparative balance sheet and a comparative income statement from two different periods, okay, 2015, 2016. And what we're going to do is we're going to take these comparative financial statements and we're going to compare usually 2 years. You can do more, but we're going to use 2 years. We're going to compare two things. First, the dollar change and the percentage change between years. Okay, so those are the two things that we're going to look at based on dollars. Did it go up or go down? That change, what is it as a percentage? Did it go up 50%? Did it go down 10%? So what we need to do is really be careful when we're conducting this analysis, okay, especially when we're comparing percentages, right? Small numbers in the denominator, that's going to throw everything out of whack. Negative numbers, definitely going to throw everything out of whack, okay? So let's look at horizontal analysis, okay? And let's just start off with total assets. So we noticed that in 2015, they had total assets of $3,197,877, okay? In 2016, they had $3,615,789, right? Okay, great. Those are values. What does that tell us? Well, the first thing we want to look at is what is the dollar change? How much did it increase or decrease? Well, total assets went up between 2015 and 2016 in the amount of $417,902. Okay. Well, what percentage is that change? Well, that change that's a 13% change or 13% increase from beginning to ending. Okay, and that's all horizontal analysis is. We pick each one of these items and we just go across, right? We calculate the change in dollars and then we calculate the change in percentage. That's it. And we can do this both for income statement and balance sheet. So look at the income statement. And look at that net income. In 2015, net income was $199,500. In 2016, it's $362,628. So what is the change? Well, in dollars, it went up $163,000 basically. That change, what is that from a percentage standpoint? Well, it's 81.8%. That means our net income increased 81.8% compared to last year. Okay? When we're looking at trend analysis, we're kind of doing the same thing, but we're going more than 2 years, right? So notice we have 2016, 15, 14, 13, and 12. So we're going to, and a lot of companies do this, we're going to provide a 5-year trend analysis, okay? And we're going to look at key items, things like sales, net income, total assets. Now, whenever we calculate or we do trend analysis over multiple periods, we need to base our changes on the initial year. So we're going to use 2012 as our base year, okay? And this allows us to see the growth over the 5-year period, in addition to year-to-year growth like we looked at on the previous table, okay? So we're seeing that, let's look at sales, net sales, right? 2012, we had $492,517, right? That's our base year. In year 2013, we went up to $786,135. That's basically 160% of the base year. Same thing with 2014, right? We take 2014 divided by our base year, we get a percentage of base year of 275%. So we could see how over time our net sales are really growing exponentially, okay? Now, vertical analysis, super duper easy, right? We said that trend analysis goes across, right? Common size financial statements or common size analysis looks at one financial statement and looks at all the items within a category, okay? So basically what we're going to do when we're doing common size financial statements is we're going to determine how each account for a single year compares as a percentage of a key figure. If we're using the balance sheet, we're going to use total assets. If we're using the income statement, we're going to use net sales. Those two things are kind of important, right? You need to know that as far as what is that key figure that I'm using? Well, total assets on the balance sheet, net income on the income statement, okay? So what this allows us to do from a investment perspective is it allows us to analyze two different companies that are of different sizes, okay? Let me show you what I mean by that. So notice what we have here. We have the coffee roasters company, right? We have the income statement, this is the balance sheet for 2015, 2016. So notice what we're doing. Our current assets, our total assets here, we're basically taking each of these items and see what do they compare as part of their total assets. Okay? We do the same thing with net sales, right? Net sales is 100%. So looking at 2016, we want to know what is cost of goods sold as a percentage to net sales. Well, in 2016, we just divide cost of goods sold by our sales. We get 67.1%. We do the same thing for 2015. We get 65.9%. So we could see, as we're looking at those common size financial statements, how those numbers change over time. Well, 67% of our net cost or our net sales was eaten up by cost of goods sold. In 2015, only 65% of our net sales was eaten up, I guess you could say, by cost of goods sold. Okay? Financial ratios, I'm just going to run through these pretty quickly because we did look at a lot of these. So we're going to look at number one, profitability analysis. If we want to see how efficient a firm is at its core operations, right? How efficient is it at running its business and generating a profit? We're going to look at these ratios. We're going to look at the gross profit percentage, return on sales, asset turnover, return on assets, and return on common stockholders' equity. Now, a number of these we've already talked about. I believe we did talk about return on sales and asset turnover and return on assets. Another example that we could use, another ratio analysis that we would want to conduct is short-term liquidity, meaning what is the company's strength and what is its ability to satisfy current obligations as they come due. Well, we're going to use things like working capital. We're going to use the current and the quick ratios. We're going to look at operating cash flow to current liabilities ratio, which we talked about in chapter 12. We're going to look at AR turnover. We're going to look at average collection period. We've seen those before. We're going to look at inventory turnover. We're going to look at day sales in inventory. So the real key takeaway here is being able to identify which ratio falls under which category. So we already looked at profitability. We looked at short-term liquidity. Now we're going to look at long-term solvency, right? Long-term solvency says, what's the firm's ability to repay its long-term debt? Well, in order to analyze that, we need to look at the debt-to-equity ratio, the times interest earned ratio, and the cash flow to capital expenditure ratio, which we just saw in our last chapter. Finally, we have ratios that look at common stockholders. We're going to look at things like earnings per share, price earnings ratio, the dividend yield, the dividend payout ratio. Okay? How do we calculate gross profit percentage? We take our gross profit divided by our net sales, right? We've seen this one before. Return on sales, net income divided by sales. We've seen this before. Asset turnover. I know we did this for a fact, right? Same thing with return on assets, right? We saw how to calculate net income divided by total assets. And basically what we're saying here is in 2016, this company had 10.6%. What does that mean? Well, the company generated 10.6 cents of profit for every dollar invested in the asset in 2016. Okay? Return on common stockholders' equity. So we take our net income, subtract out any preferred stock dividends, and we divide by the average common stockholders' equity. So what is this telling us? Well, this is saying that we can generate an increase in its return to equity from 15% to 17.2%, right? So that's a favorable change, okay? We saw working capital, right? Current assets minus current liabilities. We saw the current ratio. So we went through a lot of these over the semester, okay? We did not go through dividend yield. We just basically take the annual dividend per share divided by the market price of the share. To calculate the dividends payout ratio, we take our annual dividend per share and divide it by the earnings per share. There are some limitations with financial statement analysis, right? We have to interpret it, okay? So we have numbers, we have our ratios, but in order to interpret those, we need to look at what's the general economic condition of the country at that present time. What's the industry condition, okay? We could have great numbers, but guess what? Maybe there's a downturn in the economy coming, okay? That will impact these ratios. Presumably, they might decrease, okay? Again, when we're comparing financial statement data, right? Remember, if we use different accounting methods from one company to the next, that's going to put a big wrench in our works, okay? If we have a big company that works within a number of industries, right, like General Electric, right, they have a ton of different divisions in different industries. That's going to really make it difficult for us to compare, right? Because the numbers that we get, or the numbers from the financial statement, are made up of many different parts. We're not going to, don't worry about financial statement disclosure. You're fine with that. So that is basically chapter 13 in a nutshell. Okay. The real nuts and bolts come whenever we work on our homework problems. So I'm going to spend a lot of time demoing our homework problems. Okay. So tune back in for that one.